Hi everyone, I'm Dr. Soundararaj. I'm very happy to interact with you all through this video. In this video, I'm going to take you through the concept titled Key Factor or Limiting Factor in relation to CVP analysis. These are all a few details related to my career. After you watch the full video, if you find the video beneficial to you, give a like to the video and do subscribe my channel so that you will get the notifications of my future videos. Let's get into the problem. Raman & Co. produces two products, X and Y. The technical labor needed to produce the products is in short supply. The following data is available for the year ending on 31/3/2000. Therefore, in the given problem, it is only the technical labor which is required for producing both the products X and Y is in short supply. The other resources are available adequately. It is only the problem with the technical labor which is not available adequately. Therefore, the company has to plan in such a way it meticulously makes use of the available technical labor which is a scarce resource so that it can maximize the profit. The cost details with regard to product X, product Y. Material 40 rupees per unit of product X, 60 rupees per unit of product Y. Labor, it is 2 rupees per hour, that comes to 20 rupees per unit of product X and 12 rupees per unit of product Y. What is the understanding here? Labor rate is 2 rupees per hour. When it comes to 20 rupees per unit of product X, if you divide the 20 rupees by the 2 rupees which is the labor rate per hour, you get 10 hours. Therefore, the company has to make use of 10 hours of labor for producing every unit of X. And similarly, for Y it is 12 rupees per unit. 12 divided by 2 rupees, it gives you 6 hours. So for producing every unit of Y, the manufacturer has to make use of 6 hours of labor. So for X, it is 10 hours of labor per unit. For Y, it is 6 hours of labor hours per unit. Regarding variable overheads, it is nothing but 50% of labor cost. What is labor cost per unit of X? 20 rupees. 50% of 20 rupees is 10, and that is what presented here. And similarly, the labor cost per unit of Y is 12 rupees. 50% of 12 rupees is 6 rupees, and that is what variable overhead per unit of Y. Then regarding fixed cost at the current capacity level, it is 15 rupees per unit of X, it is 30 rupees per unit of Y at the current capacity level. This is what very important. Fine. Selling price is 100 rupees per unit of X, 120 rupees per unit of Y. Units presently sold is 900 units of X, 2000 units of Y. Maximum labor hours available per month, this is what important. Per month it is 3000 hours. But we are given with the details for the year ending on 31/3/2000. So we will do calculation for the entire year. Right. Therefore, the labor hours available to the maximum per month is 3000 hours. So it comes to 36,000 hours per annum. 3000 hours into 12 months will give you 36,000 hours, and that's a maximum number of labor hours available for the manufacturer throughout the year. If maximum profit is to be made using the remaining capacity by producing and selling the best product when labor time is limited. What is that? If maximum profit is to be made by using the remaining capacity, that means what? In addition to these two, in addition to 900 units of X, 2000 units of Y, we can make use of the remaining capacity or unutilized labor hours. What for? For producing the best product which will give us the maximum profit when the labor time is limited. And that is what stated here specifically. Present production of either product should be kept as a minimum output. That means what? Suppose you find Y is more profitable to produce when the key factor is labor hours. You can't simply produce only Y utilizing the entire lot of labor hours available. You have to produce X also to the minimum quantity, which is nothing but 900. So first you have to produce X with the minimum quantity of 900, then the remaining hours could be utilized for producing Y if Y is more profitable when the key factor is the labor hours. We will decide. Determine the profit. After you determine the suitable production mix of X and Y, you calculate what is going to be the maximum profit the manufacturer could generate using the suitable or appropriate product mix. Let's have a look at the calculation done here. Statement showing key factor contribution. Particulars product X per unit, then product Y per unit. Fine. Now selling price 100 rupees is the selling price per unit of X. 120 rupees is the selling price per unit of Y. Regarding variable cost, material 40 rupees per unit of X, 60 rupees per unit of Y. Labor 20 rupees per unit of X, 12 rupees for every unit of Y. Then regarding variable overhead, it is 10 rupees per unit of X, 6 rupees per unit of Y. So therefore, the total variable cost for every unit of X comes to 70 rupees. For every unit of Y, it comes to 78 rupees. If you subtract the variable cost from the selling price, now for X, from 100, if you subtract 70 rupees, you get 30 rupees as contribution margin per unit of X. The similar calculation is done for Y. From the selling price 120, if you subtract the variable cost of 78 rupees per unit, you get the balance of 42 rupees as the contribution margin per unit. Now let us calculate what is the contribution margin for every labor hour with regard to product X and with regard to product Y. Why it is so? Because in this problem, labor hour is a key factor. Therefore, we try to calculate the contribution for every labor hour from product X and product Y. Now 30 rupees contribution per unit of product X divided by 10 hours required for producing every unit of X, that is what we discussed and it is done here also. See, 20 rupees divided by 2 rupees per labor hour, it gives 10 hours. That means for producing every unit of X, the factory has to put in 10 hours of labor hours. So 30 rupees divided by 10 hours, it gives us 3 rupees as the contribution for every labor hour with regard to the product X. With regard to product Y, 42 rupees is a contribution per unit of Y. To get the 42 rupees contribution, we need to employ 6 hours of labor hours. So for every unit of product Y, we need to make use of 6 hours of labor hours, and 42 divided by 6 gives us 7 rupees as a contribution Y gives for every labor hour. Now, among the two products X and Y, which product gives higher contribution for every labor hour? It is product Y, which gives 7 rupees, which is higher than that of rupees 3 that is given by product X. So therefore, which is profitable product when the key factor is the labor hours? In this problem, it is product Y, which is the profitable product to be manufactured utilizing the remaining labor hours that are going to be available after producing the minimum quantity of product X. Now let us do the calculation. Calculation of optimum production of products X and Y. Maximum labor hours available per annum, it comes to 36,000 hours because for a month 3,000 hours are available. So 3,000 hours into 12 months it gives 36,000 hours. Now labor hours to be spent for minimum production of product X, that's nothing but 900 units into 10 hours for every unit, it gives us 9,000 hours. If you subtract 9,000 hours from 36,000 hours, the remaining labor hours available for producing the profitable product is 27,000 hours. Therefore, the factory can make use of these 27,000 hours to produce the profitable product Y. Now, for producing every unit of Y, the factory requires 6 hours of labor hours. So, 27,000 hours divided by 6 hours, it gives us 4,500 units. Therefore, the factory can produce 4,500 units of Y utilizing the remaining labor hours available after producing the minimum quantity of 900 units of product X. See, the most profitable product mix in the given situation, X the minimum quantity of 900, Y the maximum possible 4500 units. Now let us do the calculation of the contribution and the profit from the profitable product mix. Contribution from product X, 900 units into 30 rupees, that's a contribution margin for every unit we calculated in the beginning of the solution. Now it comes to 27,000 rupees. With regard to product X, 4,500 units into 42 rupees is a contribution margin per unit of product Y. It comes to 1,89,000 rupees of contribution from product Y. The total contribution comes to 2,16,000 rupees, from which we are going to deduct the fixed cost. This is where you need to be very attentive. See, listen, how the fixed cost is calculated. The fixed cost was 15 rupees per unit of X when the factory produces 900 units. Therefore, you need to multiply the 15 rupees with the 900 units and calculate 13,500. And similarly, the fixed cost was 30 rupees per unit of Y when the factory produces 2000 units of product Y. So it comes to the total of 60,000. If you total these two amounts, you get 73,500 rupees as a total fixed cost for the entire factory. You all know fixed cost remains constant. Which fixed cost remains constant? The total fixed cost remains constant. Whereas fixed cost per unit will vary according to the level of utilization of the production capacity. Therefore, the 73,500 rupees has to be calculated very meticulously. So, you need to understand the fact that the per unit fixed cost is not going to be the same. It will vary according to the volume of production. But the total fixed cost 73,500 is going to be the same when you produce 900 units of X, 2000 units of Y, or when you produce 900 units of X and 4,500 units of Y, the 73,500 rupees, which is a total fixed cost, going to be the same. This is the point you need to understand very clearly. Now, if you deduct the total fixed cost from the total contribution, you come to know 1,42,500 as a profit to be generated from the profitable product mix in the problem. It's a very interesting problem where you find there is only one key or limiting factor. I will release few more videos in relation to the key factor and limiting factor. Thanks for watching this video. I'll meet you in another video. Bye for now, everyone.